The Congress Party's election pledge on wealth redistribution and Sam Pitroda's remarks on inheritance tax have reignited a discussion on the taxation system eliminated in India back in 1985. Hello, I am Monika Yadav, and in this video we will explore the concept of inheritance tax and consider the potential consequences of its implementation in India. Inheritance tax is a tax paid by the person who inherits assets from someone who has passed away. When property or assets are passed on to legal heirs like children, siblings, or a spouse, a tax is imposed on the value of those assets. Currently, India does not have an inheritance tax, so you won't be taxed on property inherited from your parents, grandparents, or spouse. However, you are required to pay taxes on any income or profit generated from these inherited assets such as rent or interest by adding it to your income and paying taxes accordingly. Now let's understand the difference between inheritance tax and estate tax. Inheritance tax is paid by the beneficiary, whereas estate tax is paid by the deceased individual's estate before the assets are distributed to the heirs. Unlike estate tax, inheritance tax depends on the relationship between the deceased and the beneficiary. Between 1953 and 1985, India had an estate tax which aimed to reduce economic inequality. This tax, governed by the Estate Duty Act 1953, worked on a sliding scale where smaller estates had exemptions but larger ones faced rates as high as 85%. However, due to issues like low revenue collection, asset hiding, and the existence of Benami properties, it was done away with in 1985 by the Congress government led by Rajiv Gandhi. Double taxation concerns also emerged because assets were subject to both estate duty and wealth tax. Later, wealth tax was also abolished in 2015. While several countries across the world, including Italy, Belgium, Japan, South Korea, France, United Kingdom, and the United States have been imposing inheritance tax in the range of 4 to 80%, such taxes are not suitable for India currently, considering various social, economic, and political factors. Corporate and personal income tax, including capital gains on the direct tax side and GST on indirect side, have seen a significant surge in the last few years, much beyond the projections, and there doesn't seem to be a need to introduce a new tax without an adequate rationale. Also, if India introduces an inheritance tax, it might make it harder for families to pass down businesses and wealth to their children. This could affect the goal of making India a top manufacturing hub by creating obstacles in continuing family businesses and investing in manufacturing projects for the future. In addition, implementing inheritance taxes could disrupt family-owned businesses and lead to economic imbalances. High net worth individuals might move their wealth and businesses abroad, which may impact India's economic landscape. So with this, we have come to the end of this video. Thank you for watching and stay tuned for more such topics.